Hello, I'm John Pearce. Welcome to this investment update. As you all know, with yet another outbreak of war in the Middle East, the last couple of months have been very eventful, to say the least. In this update, I plan to explain why the markets, particularly the share markets, have been so resilient despite the turmoil. I'd like to talk a little bit about what may matter most going forward. And finally, we'll conclude with a few lessons. Now, not so much new lessons, but lessons that I believe have been reinforced with recent events. So the backdrop we're all aware of, on the 28th of February, the US and Israel launched strikes on Iran. Iran retaliated by blocking the Strait of Hormuz. Now bear in mind this waterway, 20% of the world's oil, gas and 30% of the world's fertiliser is transported. It goes without saying, this is a really big deal, and at time of recording, the strait was actually closed. Not surprisingly, the impact on energy prices was significant. Tracking the price of oil, for example, we see that tensions were actually starting to build up in the lead up to the strikes, and in early February we had oil increasing in price from around $65 a barrel to $72. The strikes happened and oil shot up to around $120. It has since receded to around $100 following a ceasefire. So far, all this is quite understandable. So that's energy prices. What about the share market? Now, this is where it gets a bit more interesting. Indeed, when the oil prices were at $120, the share market was plummeting. The US market was down over 9% at that time. But since then, it's staged a remarkable recovery. And as we record today, the US share market is trading at about 2% higher than where it was prior to the strikes. And this is despite the fact that oil is still trading at $100 and there is no signs of resolution to this conflict. Now, I don't want to dwell too much on the state of the war because, quite frankly, by the time this recording goes to air, the facts would have changed. I'd rather spend time explaining the share market response. But before we do that, let's have a look at the performance of a couple of key options. Our balanced option, which is the biggest by a long way, financial year to date, around 6.6%. Now, you might recall that I've said a few times, following 3 consecutive years of double-digit returns, I felt the chances of another year of double-digit returns was very low. And if you asked me a few weeks ago, I would have said the chances are 0. But we're at 6.6%. We've got a couple of months to go. Anything could happen. The sustainable balanced option is actually underperforming its standard equivalent by a reasonable margin. Now, over the long term, typically you'd find there'd be convergence with these performances, but over the short term, we do get differences because of the exclusions. In particular, the sustainable balanced option is heavily underweight the high-flying materials and energy sectors. So getting back to the performance of the share market, a few points. Firstly, once again, we see a situation where a major geopolitical event has not translated into a lasting negative impact on the share market. In fact, I would suggest that fear levels didn't rise much at all. Now, why do I say that? It's because we're the finance industry. We measure fear. Let me introduce you to the VIX index. Now, a lot of us don't even know what VIX stands for, so let's call it the fear gauge. What it really is a measure of volatility. So when the markets are gripped with fear, we see high volatility. And bull markets tend to be associated with very low volatility. How did the VIX perform over the last 12 months? Take a look at this graph. 12 months ago, during Liberation Day, look how high the VIX spiked. Compare that to the recent episode, we see nowhere near the same level of fear. And in fact, as we speak today, that fear is all but dissipated. What is the share market telling us? Is it saying that, look, the conflict's pretty much been resolved, oil's going back to $65? I don't think so. I think a more likely interpretation is this, that even if oil stays elevated, even if this conflict is not going to be resolved for some time, it's not going to be enough to derail global growth. In particular, it won't be enough to derail the growth in corporate profits that are being driven by investment super cycles. You know, we're talking about the super cycles in AI, data centres, the energy transition, infrastructure. All this is contributing to growth, and this is still happening regardless of what's happening in the Middle East. So that's the share market. What about the bond market? Well, this is the opposite story. Bond yields have actually risen, so bond prices have fallen, because the bond market is more worried about inflation than a slowdown in growth. This is important going forward because I believe it's the course of inflation that will ultimately determine the course of the share market. And policy will really make a difference here. Do you remember COVID? In response to the supply shocks that we saw during COVID, central banks and governments flooded economies with cash and credit. The consequences of that was much higher inflation, much stickier inflation than we should have had. Let's hope that governments and central banks have learnt from those errors. I think there's promising signs with central banks. We've seen a pausing of rate cutting cycles, and we've also seen some central banks, like the RBA, getting into hiking mode. I don't have the same confidence, frankly, that governments will show the same restraint. Finally, let's conclude with a few lessons that I believe have been reinforced. Lesson number 1, beware the predictions of geopolitical experts. Now, these predictions don't hold much value when the actors involved are irrational and unpredictable. Now, there's a school of thought that Trump's administration acts with a grand master plan in mind, that Trump himself plays four-dimensional chess. He's ahead of the game. What nonsense. I think this satirist from the New Yorker, peddling his own fake news, sums it up pretty well. From the time this war started, it's pretty clear that it was devoid of a coherent strategy. It's been riddled with miscalculations from go to woe. Lesson number 2. Despite the reservations and concerns the world might have with US leadership, in times of a crisis, global capital still flows to the US, and that's indeed what happened during the height of the recent panic. The death of US exceptionalism may indeed come one day, but it's not today. Lesson 3. That was country. What about asset class? Well, in times of crisis, history keeps reminding us that the only truly consistent, reliable safe haven is the humble cash account. So, when share markets were falling recently, gold prices were also falling, bond prices were falling. Now, these are traditional safe havens. Cash was stable throughout, of course. Which leads us directly on to lesson number 4. Yes, it's true that cash is king during times of acute crisis, but that may come at a cost, and it's usually a cost of missing the recovery. Take a look at this, one of my favourite graphs. Investing in the Australian market over the last 30 years. If you were fully invested in the Aussie market, your return would have been about 9.4%. If you had just missed the 10 best days in that last 30 years, that return reduces to 7.5%. That's a big drop when you think about the compounding impact of that. And that's just 10 days. And we know it's impossible to predict when those 10 days are going to happen. They happen often at the most unlikely of times. And it goes on. If you miss the best 20 days, the return goes to 6.1%. Now, during the recent turmoil, we did have a lot of switching out of our growth options into defensive options such as cash. It was actually about $1.4 billion in total. About $300 million has since moved back, but that means there's still a lot of money sitting on the sidelines. It's missed the recovery. Now, it's not over yet, so those members might still get a chance to get back in at lower prices, but we just don't know. It's all a bit of a gamble. So I'll finish on my favourite and most important lesson: timing the market beats timing the market. Thank you for listening.